Hello and welcome. We've all seen the incredible innovation happening in decentralized finance. You've got automated market makers, lending protocols, all these amazing bridges. It is a really, really remarkable stack of financial tech. But there's a gaping hole. There's this fundamental piece missing. The one thing that separates a truly robust financial system from, well, a casino. So today, we're diving into that missing piece, a real, functional risk management layer.
Okay, let's just jump right in with a quote that perfectly frames the problem. When you really strip away all the hype, what you have is a system that is just overflowing with potential, but it's also packed with unpriced, unmanaged risk. Now, if you're a serious institution, if you're sitting on a risk committee looking at this space, that is a complete non-starter. But what if? What if you could actually price that risk? What if you could insure it?
So here's our game plan. First, we're going to put some real numbers on that risk. Then we'll look at why the first attempts at insurance kind of fell flat. After that, we'll get into the big idea, this huge shift to computational insurance, and we'll compare it directly with the old legal model, especially when it comes to getting paid. And finally, we'll see how all of this creates the regulatory shield needed to connect DeFi to global finance.
All right, so let's quantify this risk. Just how big is this casino really? It's time to put some hard numbers on the table to understand the sheer scale of the capital that's just sitting in the danger zone right now.
Okay, here's the number everyone always talks about, total value locked, or TVL, over $100 billion. And look, it's a huge figure, right? It's a massive testament to the industry's growth, but let's look at it another way. It's also a measure of exposure. It's the total amount of money that's at risk.
Now, compare that $100 billion to this number. This is the total value covered, or TVC. The slice of that capital that is actually insured. The gap between these two numbers is, well, it's kind of insane, and it really tells the entire story of DeFi's immaturity. You do the math, and it's just staggering. Only half of 1% of all that money is covered. That means the system is 99.5% uninsured. Think about that in any other field. Would you ever get on a plane that was only 0.5% safety tested? No way. This isn't a sustainable model. It's a catastrophic failure in risk management that's just waiting to happen. So you're probably thinking, okay, but wait, haven't people tried to build insurance for DeFi before? And yeah, they absolutely have. But those first-generation protocols, they were built on a fundamentally flawed foundation. Let's dig into why they didn't work.
The real killer was something called the reflexivity trap. See, the early protocols used DeFi native assets, like Ether, to back their insurance policies. But think about what happens when a major hack or exploit occurs. The whole market panics, right? And the value of that Ether collateral just plummets, right at the exact moment you need it most to pay out claims. It's like trying to insure a house against a fire using a bucket of gasoline as your extinguisher. It just doesn't work.
So it all boils down to two main failures. First, the capital source was just wrong. It was directly correlated to the very risks it was supposed to be covering. And second, the people providing the capital were wrong. They were mostly retail yield farmers just chasing crazy high APY, not stable, long-term underwriters. What the system actually needs, what it's desperate for, is uncorrelated institutional-grade capital that doesn't panic when the crypto market gets volatile.
And this brings us to the solution. And it's not about just making a decentralized version of Geico. No, it's about a complete paradigm shift. We're talking about moving from slow, ambiguous legal contracts to fast, precise computational verification.
And this is where it gets really cool. Just look at the contrast here. On the left, you've got the legacy world. 40-page legal documents, human adjusters, and claims processes that can drag on for 6 months, maybe more. But on the right, you have the future. You have insurance that is so granular it can cover a single transaction. You have automated verification of events. And you have payouts that are atomic, which just means they happen instantly and completely, often within the very same block as an exploit.
Let's zoom in on that last point, because the claims process is where this whole revolution really becomes crystal clear. The difference between waiting for some human adjuster and getting an atomic payout is, well, it's the difference between two completely separate universes of risk management. Okay, so in the old model, a crisis kicks off this long, painful process. First, you file a claim. Then you wait for a human adjuster to investigate. Then it probably goes to a legal review. There are bottlenecks at every single step, and a payout? That might come months down the line, if it comes at all. It's slow, it's expensive, and it's totally uncertain. And this just says it all. In the new model, there is no claims department. There are no adjusters. There is only state verification.
In plain English, the insurance smart contract is programmed to watch the blockchain for a specific, provable event, like, say, funds getting drained from a specific address. If that condition is met, bam, the payout is triggered, automatically, instantly. It's a system of trustless, deterministic resolution.
Now, this isn't just some cool tech for crypto insiders. This efficiency, this absolute certainty, this is the exact thing that large-scale regulated financial institutions have been waiting for. This is the key that unlocks the door for them.
You know, think about a major fintech like Revolut or Chime. They might be looking at the 5% yields in DeFi and thinking, wow. But their risk committees, their regulators, they are never, ever going to approve deploying billions of customer deposits based on the mantra, the code is the law. It's just not a valid risk management strategy in their world. For them, insurance isn't a nice-to-have, it's an absolute hard requirement.
So, at the end of the day, programmable insurance acts as a kind of translation layer. It takes this scary, opaque, technical risk and it turns it into a clear, priced line item on a balance sheet. It actually creates a market price for a protocol's security, making it legible. This is the regulatory compliant shield that institutions need to feel safe enough to deploy billions of dollars into DeFi.
And once you have that shield, you finally have the bridge. And this isn't just about protecting the DeFi users we have today. This is about unlocking the next $1 trillion of liquidity and onboarding the entire global financial system.
But to get there, we really need to change how we measure success. For years, we've been obsessed with TVL, which, as we've seen, is really just a vanity metric that measures how much capital is in the danger zone. The true measure of the industry's maturity, the number of real risk committee cares about, has to be TVC, total value covered.
And I think this analogy just nails it. Over the last few years, the DeFi community has built this incredible financial engine. It's got powerful liquidity pistons and cross-chain transmissions, the whole shebang. But they kind of forgot the safety features. Programmable insurance isn't just an add-on, it's the brakes and the airbags that make the entire vehicle safe enough for everyone to get in.
So this all leads us to our final question. By pricing risk, automating claims, and providing that regulatory shield, is this new form of computational insurance the final, critical piece that DeFi's been missing all along? Is this the thing that finally elevates it from a fascinating high-stakes experiment into a truly resilient global financial utility? Well, the pieces are finally on the board.